Dan Ives just made a huge call on CNBC Closing Bell about the future of AI, saying, "The consumer AI revolution starts right now." In this video, we're going to break down exactly why the Wedbush tech analyst believes Apple and other major tech companies are entering their next massive growth phase. First, I'll show you the full Dan Ives interview clip. Then I'll give you my own detailed reaction and breakdown of what he really meant, including my thoughts on the stocks he mentioned and the future of AI investing. And after that, I'll reveal my in-depth analysis of 3 of the best stocks to buy right now. Let's hear what Dan Ives had to say.
How about Apple today hitting a new high in its own right? Wedbush's Dan Ives, he's here at Post 9 because he just raised his price target on the stock to a street high $400. That's why you've come by, up from $350. What's got you even more bullish about a name? You're pretty bullish always on.
Sure, but I think it's the setup here. I mean, if you look from an iPhone perspective, services, now obviously the baton's been handled to Turnus, but it's about AI. I mean, I think when we go to WWDC...
1 month from today, by the way, we're going to be live there. You'll be with us on site as for our annual trip for that event.
Yeah, and I think to some extent now the golden age begins in Cupertino, because it's my view from a Gemini perspective in terms of what they're going to announce from partnership. But it really starts what's going to be the foundation for consumers. They're going to be using AI when it comes from an iPhone perspective. This is going to be the consumer AI revolution, what ultimately will be subscription services, apps. And as they get a piece of the pie, that's going to be an incremental 10, 12, $15 billion annually on the services side. I think this finally starts now, the AI chapter at Apple.
You don't feel like you need to actually see some results before you do something like bump your price target up by $50? I mean, the stock's already had a nice run as well. Why not sit back and wait to see if they deliver on all of these things with all the superlatives that you deliver?
It's a great question, but if I look at this next iOS and everything from a developer perspective that looks like it's going to be in there, this is finally it in terms of Apple Intelligence, Siri AI. They're now going to have the ability, whether it's Gemini, whether it's ChatGPT, whether it's Claude, this will now be the foundational piece. It's very important because I think what investors are underestimating is this will now will be an AI-enabled device, probably in 2027, but Apple will be, they're essentially going to be, think about them like on this highway, they're going to be the toll collector for consumers on AI.
Okay, so I want to talk about Meta before I let you go, because we've been doing segments on the fact, and there was a Heard on the Street article this week that I thought set the argument up pretty well. You got a stock, I think it's like 18 times. Is that an opportunity, or is it a warning sign? And I think you could fill both of those answers out almost equally. The market doesn't seem to be convinced that stock is an opportunity so much as there's now risk that you need to keep your eye on. How would you address why Meta, from the March lows, certainly has underperformed these other names?
I think it just comes down to like the CapEx that they're spending. You haven't seen it yet. And if you look at this last call, it was the most underwhelming in terms of Mag 7. But it speaks to my view, like they're making the right investments, because the reality is for them to monetize on the advertising side, the billions of users, it's what they need to do. But look, the next few quarters, they need to show it, because when you look at Google, when you look at Amazon, when you look at a lot of the other big tech players, everything in semis, as a portfolio right now, as a manager, you want to invest in the names that are showing it. Meta's not showing it. We're still strong believers, in terms of where I believe they'll be able to turn this around.
Well, I mean, they obviously, look, Jensen Huang told me straight up before the Super Bowl, nobody does AI better than Meta. I think people would potentially agree with that as related to the advertising business, right? But not to call them a one-trick pony, because they obviously have other businesses, but they don't have cloud. That was one of the focuses of this story, right? Amazon's got cloud, Google's got cloud, Microsoft's got cloud, Meta doesn't have cloud.
But look, then you could say, like, look at Oracle. They're transforming themselves into a hyperscaler, but it takes a lot of money to actually do that. I think when it comes down to Meta, call them a one-trick pony, but you have billions of users they're going to monetize. When it comes to
user growth is slowing, right? Sequentially.
Sequentially.
Haven't seen that in forever.
but
That's not a problem?
It was a problem this quarter, but I believe the next few quarters, I think it's a one-off. I do not think subscriber growth stops here. I think they're going to be able to actually accelerate that, start to monetize AI spending, and then when it comes from a CapEx perspective, actually maybe soften that a bit as we go in the second half of the year as you execute. But then it goes back to a year ago, the narrative on Alphabet, no one would own that. Look how negative it was. They proved it, and look where they are today.
The interview starts with Apple hitting another new high, and Dan Ives comes in immediately saying he raised his price target from $350 all the way to $400. That is not a small move. A lot of analysts will slowly inch targets higher over time, but jumping another $50 after the stock already had a huge run tells you he thinks Wall Street is still underestimating what is coming next. And the core of his entire thesis is AI. Not just AI in a general sense, but specifically Apple becoming the center of consumer AI adoption. That was really the key point he kept hammering home throughout the conversation. He talked about WWDC being the moment where the so-called golden age begins in Cupertino. And I think what he means by that is Apple is finally about to enter the AI race in a visible way that regular consumers can actually interact with every day. Because for the last couple of years, most of the AI excitement has been centered around companies like Nvidia, Microsoft, OpenAI, Google, and Meta. Those companies have been building the infrastructure, the models, the chips, and the cloud systems. But Apple has been relatively quiet, and some investors interpreted that silence as Apple falling behind. But Dan Ives is basically arguing the opposite. He is saying Apple intentionally waited because they do not necessarily need to invent the best AI model themselves. They just need to control the ecosystem where consumers actually use AI. That is a very important distinction. Apple owns the iPhone ecosystem, they own the App Store, they own iOS, they own the services layer, and if AI becomes deeply integrated into everyday smartphone usage, Apple could end up collecting revenue from almost every interaction happening on the device. That is why he used the toll collector analogy. Honestly, I think that may have been the smartest part of the entire interview, because if you really think about it, Apple has always been at its best when it acts as the gatekeeper. They did it with apps, they did it with payments, they did it with subscriptions, and now they may try to do the exact same thing with AI. So even if ChatGPT powers some features or Gemini powers other features, Apple still controls the hardware and operating system where everything happens. That means they can monetize usage without necessarily building the leading AI model themselves. And personally, I think a lot of investors still underestimate how powerful that business model is. Apple does not always need to be first. They just need to be the company consumers trust the most. That matters especially with AI because privacy concerns are going to become massive over the next few years. People may not want all their personal data floating around random AI platforms. Apple has spent years branding itself around privacy and security, so if they can combine that reputation with AI functionality, that could become incredibly powerful. Dan Ives also made another interesting point when he talked about services revenue potentially increasing by an extra $10 billion to $15 billion annually because of AI integration. Now that is a huge statement, because investors already love Apple's services business. Services are high-margin recurring revenue. That is the type of revenue Wall Street pays premium valuations for. So if AI can increase subscription usage, app spending, premium assistant features, or ecosystem lock-in, then suddenly Apple's earnings potential expands much faster than people expect. And this is where I think the market is getting really interesting right now. For years, Apple was viewed mostly as a mature hardware company. Great business, massive cash flow, but slower growth. AI may completely change that narrative. Suddenly, investors are starting to think maybe Apple can enter another major upgrade cycle. Dan Ives hinted at that too when he talked about AI-enabled devices arriving by 2027. And honestly, this could become the next supercycle for iPhones. Think about it. Most people today use their phones pretty similarly. Social media, texting, photos, videos, maps, streaming. But if AI assistants become deeply personalized and integrated into daily life, consumers may actually need more powerful devices to fully run those features. That could create another wave of hardware demand. And Apple knows exactly how to monetize upgrade cycles better than almost any company in the world. Now, one thing I found interesting was the interviewer pushing back against him, because the interviewer basically asked, shouldn't you wait to see actual results before raising your target this aggressively? And honestly, that is a fair question. A lot of what Dan Ives is talking about is still forward-looking. We have not fully seen Apple's AI ecosystem yet. We have not seen massive AI monetization numbers yet. We have not seen consumers completely change their behavior yet. But Dan's response was basically that the setup itself is enough. He believes the next version of iOS and the upcoming AI integrations are going to fundamentally change investor perception of Apple. And in markets, perception changes often happen before financial results actually appear. That is important for investors to understand. Stocks usually move ahead of the actual earnings acceleration. By the time the numbers become obvious, the stock has often already rallied significantly. So Dan Ives is essentially betting that Wall Street will re-rate Apple higher before the full AI monetization even shows up in the financials. Now, whether that happens or not remains to be seen, but you can definitely understand the logic behind the argument. Then the conversation shifts over to Meta, and this part of the interview was honestly very revealing because it showed the difference between companies that investors believe are already monetizing AI successfully versus companies that are still spending heavily without clear visible returns yet. The interviewer brings up Meta trading around 18 times earnings and asks whether that low valuation is actually an opportunity or maybe a warning sign. And this is where the debate around Meta gets really fascinating, because Meta is clearly one of the leaders in AI capability. Even Jensen Huang himself apparently told the interviewer that nobody does AI better than Meta. That is a huge compliment coming from the CEO of NVIDIA. But despite that, Meta's stock has lagged compared to some of the other major tech names recently. Why? Because investors are nervous about the massive spending. Meta is pouring billions and billions into AI infrastructure, data centers, chips, talent, and long-term projects. And unlike Microsoft, Amazon, or Google, Meta does not have a dominant cloud business generating direct AI infrastructure revenue. That is the key issue. Microsoft can monetize AI through Azure, Amazon monetizes through AWS, Google monetizes through Google Cloud, Meta mainly monetizes through advertising. So investors are asking whether all this spending will actually generate enough returns. Dan Ives basically acknowledged that concern directly. He even admitted Meta's last earnings call was probably the most underwhelming among the Magnificent Seven companies. But he still defended the spending, and honestly I can see both sides of this debate. On one hand, Meta absolutely has to invest aggressively. If AI transforms digital advertising, recommendation algorithms, social engagement, and creator tools, Meta cannot afford to fall behind. But on the other hand, Wall Street eventually wants proof. At some point, investors stop rewarding spending alone and start demanding monetization. And that is exactly what Dan Ives said. He believes the next few quarters are going to be critical because Meta now needs to show that all this AI investment is translating into actual business acceleration. What I found especially interesting was when they discussed Meta potentially being viewed as a one-trick pony. The interviewer basically argued that unlike Microsoft, Google, or Amazon, Meta lacks diversification because it does not own a massive cloud infrastructure business. And that is a legitimate concern, because cloud computing has become one of the biggest AI monetization engines in the entire industry. But Dan Ives pushed back by saying Meta still has billions of users, and that point matters a lot. Billions of users is an incredible asset in the AI era, because AI models become more valuable when they have massive engagement, massive data, and massive distribution. Meta owns Facebook, Instagram, WhatsApp, and Threads. That is an enormous global ecosystem. Personally, I think people sometimes underestimate how difficult it is to compete with that level of scale. Even if user growth slows temporarily, Meta still controls one of the largest attention networks on Earth. And if they successfully integrate AI into advertising tools, content recommendations, creator monetization, and messaging platforms, they could eventually justify all this spending. But I also think investors are right to demand evidence now. The market environment has changed. A few years ago, investors were rewarding pure vision and long-term promises. Today, they want actual AI revenue growth, actual margin expansion, and actual monetization. And that is why Meta has faced more skepticism recently despite being one of the strongest technical AI players. Another important moment was when the interviewer pointed out that user growth had slowed sequentially for Meta. That caught attention because Meta almost never shows weakness there. Dan Ives dismissed it as more of a one-off issue rather than a long-term problem. He believes subscriber and user growth can accelerate again once AI monetization starts improving engagement and advertising efficiency. And honestly, that is probably the central bet for Meta investors right now. Can AI make Meta's platforms dramatically more profitable? If the answer is yes, then today's spending may eventually look genius. If the answer is no, then investors may start viewing all this AI capex as excessive. So overall, what this interview really showed me is that we are entering the next phase of the AI market. The first phase was infrastructure, chips, data centers, cloud computing, and foundational models. Now we are moving into the consumer monetization phase. How do companies actually make money from AI at scale? Apple believes the answer may be ecosystem control. Meta believes the answer may be advertising optimization and engagement. Microsoft believes the answer is enterprise software integration. Google believes the answer is search and cloud. And Nvidia is essentially selling the tools to everybody. Personally, I still think we are incredibly early in this entire cycle, and I think that is why analysts like Dan Ives remain so bullish despite the massive rallies already happening in these stocks, because from their perspective, AI is not just another software trend. They believe it is a once-in-a-generation technology platform shift. And if they are right, then some of these current valuations may eventually look cheap in hindsight. But at the same time, I also think investors need to stay realistic. Not every company will dominate AI long-term. Some companies will overinvest. Some products will fail. Some expectations are probably getting ahead of reality right now. That is just how every major technology revolution works. There is always excitement, hype, volatility, winners, losers, and eventually consolidation. But one thing is very clear after listening to this interview. Wall Street is no longer asking whether AI matters. That debate is over. The real question now is which companies are positioned to capture the biggest share of the trillions of dollars that AI could potentially create over the next decade. Now, let's break down 3 of the best stocks to buy right now that could continue compounding wealth for years, while the broader market struggles with uncertainty, inflation fears, and slowing consumer confidence. The first stock on this list is Church Dwight, ticker symbol CHD. Now at first glance, Church Dwight might not look exciting. It is not an AI stock. It is not a high-flying technology company. It is not dominating headlines every week. But honestly, that is exactly why this business deserves serious attention right now. Because some of the greatest long-term investments in history were never the loudest companies in the room. They were the businesses quietly selling products consumers repeatedly buy during both good economies and bad economies. And Church & Dwight is one of the best examples of that type of business model. This company owns a portfolio of consumer brands that millions of people already trust and use every single day. Brands like Arm & Hammer, OxyClean, Orajel, Nair, Zcom, and Waterpik are deeply embedded into consumer habits. That matters more than many investors realize. When people are stressed financially, they may delay buying a new car. They may delay taking expensive vacations, but they are still brushing their teeth, cleaning their homes, buying household products, and taking care of their families. That creates incredibly durable demand. And durable demand is one of the most underrated advantages in investing. One of the biggest mistakes investors make is assuming exciting businesses automatically make better investments. Sometimes the boring companies quietly outperform because they are stable, predictable, and incredibly resilient during difficult economic cycles. Church & Dwight has been proving that for decades. The company has now delivered 25 consecutive years of revenue growth. Think about how impressive that really is for a second. This company survived the dot-com crash, the 2008 financial crisis, the pandemic, inflation spikes, supply chain disruptions, and changing consumer behavior, yet revenue still continued growing over that entire period. That level of consistency is extremely rare. And when you combine that with a strong balance sheet, disciplined management, and steady free cash flow generation, you start seeing why investors continue trusting this business long-term. According to the latest data, Church & Dwight generated roughly 15.7% free cash flow growth over the past 3 years. That is a major strength because free cash flow is what gives a company flexibility. It allows the business to invest in growth, pay dividends, acquire brands, buy back shares, and survive downturns without relying heavily on debt. And Church & Dwight has managed this while maintaining a relatively conservative debt-to-equity ratio around 0.60. In a higher interest rate environment, balance sheet discipline becomes extremely important. A lot of companies looked unstoppable when money was cheap. But when rates rise and financing becomes more expensive, weaker businesses suddenly get exposed. Church & Dwight has avoided many of those problems because management has historically remained disciplined instead of overextending the company. Now, another thing I really like about this business is its strategy. Church & Dwight does not rely on massive blockbuster product launches. Instead, the company focuses on small but consistent product innovation and brand expansion. That may sound less exciting than revolutionary new products, but in practice, it creates a much more stable business model. The company constantly improves products consumers already know and trust. That approach lowers risks significantly. Consumers are creatures of habit. Once they trust a household brand, they often continue buying it for years, sometimes decades. Church Dwight understands this extremely well, and management has also shown a willingness to reshape the portfolio when necessary. Recently, the company made two very important strategic moves. It acquired the fast-growing hand sanitizer brand Touchland, while also selling its vitamin business. That tells me management is actively focusing on higher priority growth categories rather than simply holding on to every business forever. That kind of strategic discipline matters. Great management teams know when to double down and when to move on. And personally, I think the Touchland acquisition was smart because it gives Church & Dwight exposure to a category that still has strong consumer demand and branding potential, especially among younger consumers. Another thing that makes CHD attractive right now is the company's defensive positioning. We are currently in a market where investors are increasingly worried about economic uncertainty, inflation pressure, geopolitical tensions, and slowing consumer spending. When uncertainty rises, investors often rotate toward businesses with reliable demand and dependable earnings. That is exactly where Church & Dwight shines. The stock also has a beta around 0.47, which basically means it tends to experience significantly less volatility than the broader market. That is important because protecting capital matters just as much as growing capital. A lot of investors focus only on maximizing returns, but experienced investors understand minimizing risk is equally critical over the long run. If you can own businesses that continue compounding steadily while avoiding catastrophic drawdowns, your long-term returns can become incredibly powerful through simple consistency. And consistency is really the story here. Church & Dwight has increased its dividend for 30 consecutive years. That alone says a lot about the company. Businesses cannot consistently raise dividends for decades unless they have reliable cash flow generation and disciplined financial management. Now, the dividend yield itself sits around 1.3%, so this is not some ultra-high yield income stock. But honestly, I actually prefer that in many cases because it suggests the company still has room to reinvest capital back into growth while rewarding shareholders at the same time. Sometimes investors chase extremely high dividend yields without realizing those payouts can become unsustainable. Church & Dwight's dividend profile looks much healthier because it is supported by durable earnings and long-term stability, and I think the market sometimes undervalues businesses like this because they are not dramatic enough. But boring consistency can become incredibly powerful over a 10-year or 20-year holding period. Think about what happens when you combine moderate revenue growth, steady dividend increases, disciplined acquisitions, stable margins, and strong consumer loyalty over decades. You create a compounding machine. And that is what long-term investing is really about. Not finding the next overnight lottery ticket, not chasing hype cycles, not gambling on whatever trend is dominating social media. It is about identifying durable businesses with staying power. And Church & Dwight absolutely fits that description. Now, another factor worth discussing is pricing power. One of the biggest challenges companies face during inflationary periods is protecting margins. If costs rise but consumers refuse to pay higher prices, profits get squeezed. Church & Dwight has historically handled this fairly well because strong consumer brands create pricing flexibility. Consumers may complain about paying slightly more for household products, but trusted brands still maintain strong demand because consumers prioritize reliability and familiarity. That is one of the hidden advantages of consumer staples businesses. Strong brands become economic moats. And when you own a portfolio of trusted household names, you gain leverage that smaller competitors simply cannot replicate easily. I also think many investors underestimate how valuable emotional trust is in consumer products. People may experiment with new brands occasionally, but when it comes to products connected to health, hygiene, cleaning, or family care, consumers often stick with what they know. That behavioral loyalty creates recurring revenue and long-term resilience. Now, from a valuation standpoint, Church & Dwight may not look extremely cheap compared to some deep-value stocks. But quality companies rarely trade at bargain basement valuations for long. The market usually rewards consistency, and honestly, I would rather pay a fair price for a great business than buy a weak business just because it looks statistically cheap. That philosophy has protected many successful investors over time, because cheap stocks can stay cheap for years if the underlying business lacks real competitive advantages. Church & Dwight, on the other hand, has multiple long-term advantages working in its favor. Strong brand recognition, stable consumer demand, reliable free cash flow, low volatility, long dividend growth history, disciplined acquisitions, and recession-resistant products. That combination creates a very compelling long-term investment profile, especially during uncertain economic periods. Now, does that mean CHD is going to double overnight? Probably not. This is not that type of stock, but if you are building a serious long-term portfolio designed to survive volatility while steadily compounding wealth, businesses like Church Dwight deserve serious consideration, because sometimes the best investments are not the companies making the loudest headlines. Sometimes they are the businesses quietly sitting in millions of homes around the world generating cash flow day after day, year after year, decade after decade, and Church Dwight has proven it knows exactly how to do that. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second stock on this list is McCormick Company, ticker symbol MKC. And honestly, this is one of those businesses that many investors completely overlook because it feels too ordinary on the surface. Most people see spices and seasonings and immediately assume there is nothing special about the company behind them, but that assumption misses the bigger picture entirely, because what McCormick has built over decades is not just a spice company, it is one of the strongest consumer staple ecosystems in the food industry with pricing power, brand loyalty, global distribution, and a product lineup deeply connected to everyday human behavior. People may cut back on luxury spending during difficult times, but they still cook, they still eat at home, they still buy seasonings, sauces, marinades, and flavor products. And the interesting thing is that food habits tend to be incredibly sticky. Once consumers trust a flavor profile or become emotionally attached to certain products, they often continue buying them for years. Sometimes entire generations grow up using the same seasonings and cooking products in their households. That creates a level of customer loyalty that is extremely difficult for competitors to break. And McCormick has been monetizing that trust for a very long time. The company operates in over 170 countries and territories, which gives it massive global scale. Its products are sold through grocery stores, restaurants, food manufacturers, and food service providers all over the world. That diversification matters because it spreads risk across multiple revenue streams rather than relying on one single market. And what really stands out to me about McCormick is the consistency of the business model. This is another company that quietly compounds over time while the market focuses on more dramatic stories. McCormick has increased its dividend for nearly 4 decades straight. That is an incredible achievement, and it immediately tells you something important about the underlying business quality. You cannot maintain dividend growth for that long unless your cash flow generation is stable and your products maintain durable demand across economic cycles. That kind of consistency does not happen by accident. It happens because consumers repeatedly return to the same trusted brands over and over again. And one of the biggest strengths McCormick has is brand dominance. When many people think about spices, seasonings, and flavor products, McCormick is often one of the first names that comes to mind. That brand recognition creates enormous competitive advantages because shelf space in grocery stores is incredibly valuable. Retailers want products consumers already trust because trusted brands move inventory faster. That gives McCormick leverage. It also gives the company pricing power, which becomes very important during inflationary periods. Over the last several years, food companies have faced rising input costs, transportation costs, labor costs, and supply chain pressure. Businesses without strong brands struggled because consumers resisted price increases, but companies with trusted household brands were generally in a stronger position to pass higher costs on to consumers. And McCormick has shown it can navigate inflation better than many investors expected. Now, another reason I think MKC deserves attention right now is because consumer behavior is evolving in ways that actually benefit the company long term. More consumers are cooking at home again compared to pre-pandemic trends. People are experimenting with recipes, international cuisines, healthier eating habits, and convenience-focused meal preparation. Flavor has become a huge part of modern food culture. Social media food trends, recipe content, and home cooking culture have all increased consumer interest in seasonings and cooking products. McCormick benefits directly from that trend, and unlike fad-based businesses, this is tied to a fundamental human activity that is never going away. People will always eat. That may sound obvious, but investors sometimes forget how valuable essential recurring demand can become over decades. Now, financially, McCormick has remained relatively stable despite broader economic uncertainty. The company continues generating billions in annual revenue while maintaining strong operating margins and dependable cash flow. The business also benefits from scale advantages. Because McCormick operates globally, it can leverage purchasing power, manufacturing efficiency, distribution networks, and retail relationships that smaller competitors simply cannot match easily. Scale creates efficiency. Efficiency protects margins. And margin stability supports long-term shareholder returns. Another thing I personally like about McCormick is that management tends to focus on disciplined long-term execution rather than flashy short-term decisions designed to impress Wall Street for one quarter. That matters more than people think. Some management teams chase aggressive expansion plans, risky acquisitions, or unsustainable growth targets. McCormick has generally remained focused on steady operational execution and gradual expansion into complementary product categories. That approach reduces unnecessary risk, and risk management becomes incredibly important during uncertain economic periods like the environment we are seeing today. Now let's talk about the company's moat, because this is where things get really interesting. McCormick's competitive advantage is not just about having recognizable products. The real moat comes from consumer trust, retail relationships, manufacturing scale, and embedded distribution networks. Getting shelf space at major retailers is extremely competitive. Maintaining that shelf space for decades is even harder. McCormick has built those relationships over generations. That creates barriers to entry that many smaller food brands struggle to overcome. And once you dominate shelf space and consumer mindshare, it becomes easier to launch adjacent products successfully because consumers already trust your brand. That is one reason why McCormick has been able to expand beyond traditional spices into sauces, seasonings, marinades, and flavor solutions. The company understands that flavor itself is the core business, not just individual products, and that distinction gives management flexibility to evolve alongside changing consumer preferences. Now, from an investment standpoint, one of the most attractive things about MKC right now is the balance between defense and growth. A lot of defensive stocks lack meaningful long-term growth potential, and a lot of growth stocks lack stability. McCormick sits somewhere in the middle. You have recession-resistant demand combined with steady international expansion opportunities, product innovation, and pricing power. That combination creates a very attractive risk-reward profile for long-term investors, especially during periods when market volatility remains elevated. Another thing worth mentioning is that many investors underestimate how powerful small recurring purchases can become at scale. Consumers may only spend a few dollars at a time on spices or seasoning products, but when you multiply that behavior across millions of households repeatedly over decades, the revenue stream becomes extremely durable. And because many McCormick products are relatively low-cost purchases, consumers are less likely to aggressively cut spending on them even during financial stress. That creates resilience. Resilience protects earnings, and protected earnings often support stronger stock performance over long periods. I also think there is an important psychological factor here that investors sometimes ignore. During uncertain economic periods, people often seek comfort and familiarity. Food plays a huge emotional role in daily life and family routines. Trusted household cooking brands benefit from that behavioral tendency. McCormick products are deeply integrated into those routines. That creates emotional stickiness that competitors struggle to replicate. Now, another positive factor is the company's continued international opportunity. While McCormick already has strong global reach, rising middle-class populations and changing food consumption habits in international markets could create additional long-term demand growth. As global consumers gain more purchasing power and become more interested in diverse cuisines and cooking experiences, flavor companies stand to benefit significantly, and McCormick already has the infrastructure and brand portfolio to participate in that growth. Personally, I think this is one of those businesses that investors appreciate more during uncertain markets than during euphoric bull runs. When speculative growth stocks dominate headlines, companies like McCormick can feel boring to many investors. But when volatility rises and investors start prioritizing durability, cash flow, and stability, businesses like this suddenly become much more attractive. And honestly, there is nothing wrong with owning boring businesses if those businesses continue compounding shareholder value year after year. In fact, some of the best long-term investment returns in history came from companies that looked unexciting on the surface but quietly executed for decades. McCormick fits that profile surprisingly well. Now, one thing I do want to point out is that defensive businesses are not immune from challenges. McCormick still faces inflation risk, changing consumer preferences, currency fluctuations, and retail competition. Investors should absolutely understand that no stock is completely risk-free, but compared to many businesses operating today, McCormick's revenue base looks relatively durable because demand for its products tends to remain stable across multiple economic conditions. That stability has value, especially when markets become unpredictable. And another thing that stands out to me is management's focus on shareholder returns. The long dividend growth history demonstrates financial discipline and long-term confidence in the business. That type of consistency tends to attract patient investors who value reliability over hype. And patient investors often outperform because they avoid emotional decision-making. One of the biggest wealth-destroying mistakes in investing is constantly chasing whatever sector is currently exploding higher without understanding business quality underneath the excitement. McCormick reminds investors that quality still matters, cash flow still matters, brand loyalty still matters, and predictable demand still matters, especially over long time horizons. Now, from a valuation perspective, some investors may argue the stock does not look cheap enough compared to slower growth expectations. But quality businesses rarely remain deeply undervalued for extended periods because institutional investors consistently seek stable cash-flowing companies during uncertain markets. And honestly, I would rather own a business with moderate but dependable growth than a highly speculative company with unpredictable economics. Consistency compounds. That is the key lesson here. Not every great investment needs to revolutionize the world. Sometimes great investments simply continue executing year after year while steadily increasing earnings, dividends, and market share, and McCormick has proven its ability to do exactly that for decades. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third and final stock on this list is Jack Henry & Associates, ticker symbol JKHY. And this company is probably the most overlooked business out of all three stocks we've discussed in this video. Because unlike flashy technology companies chasing headlines every week, Jack Henry operates quietly behind the scenes, powering critical financial infrastructure that millions of people indirectly rely on every single day. Most consumers have probably never even heard of the company, but many banks and credit unions across America depend on its software systems to operate efficiently, and that creates one of the most important qualities investors should look for in a long-term investment: mission-critical dependence. When businesses become deeply integrated into the operations of their customers, switching becomes difficult, expensive, risky, and disruptive. That creates customer stickiness, and sticky customers create recurring revenue. Jack Henry specializes in providing technology solutions and payment processing services primarily for regional banks and credit unions. Its software helps financial institutions manage core banking operations, digital banking services, payment systems, cybersecurity functions, and customer interactions. In other words, this business helps smaller financial institutions compete in a world where technology expectations continue rising rapidly. And honestly, that is a very important role in today's financial system, because regional banks and credit unions cannot afford to fall behind technologically. Consumers now expect seamless mobile banking, fast payment processing, digital account access, fraud protection, and modern financial experiences. Smaller institutions need sophisticated software infrastructure to meet those expectations. That is where Jack Henry becomes extremely valuable. And what makes this business particularly attractive is the recurring nature of its revenue model. Once a financial institution adopts Jack Henry's systems, it is not easy to switch providers. Think about how complicated banking systems really are. These are not simple software installations. We are talking about highly regulated financial infrastructure involving customer data, compliance systems, transaction processing, security protocols, and operational workflows. Migrating all of that to another provider can become incredibly expensive and risky. That creates a strong moat, and strong moats often lead to durable long-term earnings growth. One of the reasons I really like this company is because it benefits from a powerful long-term trend that still has years of runway ahead. Digital transformation in banking is far from over. Financial institutions continue investing heavily in modernization, cybersecurity, payment systems, automation, and digital customer experiences. That demand is unlikely to disappear anytime soon because banking itself is becoming increasingly technology-driven, and Jack Henry sits right in the middle of that transformation. Now, financially, the company has built a very impressive track record over time. Jack Henry has consistently generated strong operating margins, dependable cash flow, and recurring revenue growth. The company also maintains a relatively conservative balance sheet compared to many technology businesses. That financial discipline matters, especially in an environment where many investors are becoming more selective about profitability and stability. One thing that stands out immediately about JKHY is its consistency. This company has increased its dividend for more than 3 decades straight, Again, that level of dividend consistency does not happen accidentally. It reflects disciplined capital allocation, stable cash generation, and resilient customer demand. And honestly, I think investors sometimes underestimate how valuable reliability becomes over long periods. A company does not need explosive growth to generate excellent shareholder returns if it can steadily compound earnings and cash flow year after year. Jack Henry has demonstrated that ability for a very long time. Now, another major advantage here is the company's relationship-based business model. Banking institutions tend to prioritize trust and reliability when selecting technology providers. They are not constantly switching vendors looking for the cheapest option because operational stability matters enormously in finance. That creates long customer relationships. In many cases, Jack Henry maintains partnerships with institutions for years or even decades. That recurring customer retention creates predictable revenue streams that investors generally love because predictability lowers uncertainty, and lower uncertainty often deserves premium valuations. Now let's talk about something else that makes this company particularly interesting right now. Artificial intelligence and automation are transforming financial services rapidly, but not every financial institution has the internal resources to build advanced technology systems independently. Smaller banks especially need trusted technology partners to remain competitive. Jack Henry can benefit from that trend because demand for smarter banking software, fraud detection systems, digital payment solutions, and customer engagement tools will likely continue growing. And importantly, the company does not necessarily need to dominate headlines to benefit from these trends. Sometimes the best investment opportunities are infrastructure businesses quietly supporting larger transformations behind the scenes. That is exactly what Jack Henry appears to be. Another factor I really like is the company's focus on recurring revenue streams rather than relying heavily on one-time transactions. Recurring revenue businesses tend to perform better over long periods because they create stability and visibility. When customers continue paying for essential software services year after year, management can plan investments more effectively while investors gain more confidence in future cash flows. That business model becomes especially valuable during uncertain economic periods. And honestly, one of the biggest lessons investors learned over the last few years is that predictable cash flow matters. A lot of speculative businesses looked exciting during easy money environments, but when economic conditions tightened, weak business models became exposed very quickly. Jack Henry looks far more durable by comparison because its services remain essential to banking operations regardless of short-term economic fluctuations. Now, another important strength here is the company's niche positioning. Jack Henry is not trying to compete directly with every giant technology company on Earth. Instead, it focuses specifically on serving regional financial institutions and credit unions effectively. That specialization creates expertise, and expertise creates trust. By understanding the unique operational needs of smaller banks, the company can tailor solutions more effectively than broader generic providers. That customer focus helps strengthen long-term retention, and retention drives long-term shareholder value. Now, from a broader investing perspective, I think JKHY represents something many investors should pay more attention to. Not every winning investment needs massive hype or explosive narratives attached to it. Sometimes the best businesses are simply the ones quietly embedded into critical industries with dependable demand and strong customer relationships. Jack Henry operates inside one of the most important systems in the economy, the financial system itself. And financial institutions are unlikely to suddenly stop needing software infrastructure. If anything, technology dependence within banking will probably continue increasing for years. That creates long-term tailwinds. Another thing worth mentioning is the company's relatively stable operating history during difficult market environments. Because Jack Henry serves essential financial infrastructure functions, demand tends to remain more resilient than many cyclical businesses. That does not mean the stock cannot experience volatility. Every stock experiences market fluctuations at times, but from a business fundamentals perspective, the company appears positioned to maintain durable demand regardless of short-term economic headlines. Personally, I also think investors underestimate the importance of trust within financial technology. Banks and credit unions handle highly sensitive financial information. Reliability and security are absolutely critical. That creates barriers for new competitors because financial institutions are naturally cautious about trusting unproven providers with core operational systems. Established reputation matters enormously in this industry, and Jack Henry has spent decades building that credibility. Now, one area investors should continue monitoring is competition and technological evolution. Financial technology changes quickly. companies must continue innovating to remain relevant. Cybersecurity requirements also continue becoming more demanding over time, but so far Jack Henry has demonstrated an ability to evolve alongside industry needs while maintaining strong customer relationships. And that adaptability matters, especially in technology-driven industries. Another thing I appreciate about this company is that management appears focused on sustainable long-term growth rather than reckless expansion. That discipline is important because some technology businesses chase growth at the expense of profitability or operational stability. Jack Henry has generally avoided that trap. The company has prioritized steady execution, recurring revenue expansion, and customer retention. That approach may appear less exciting than aggressive hypergrowth strategies, but over long investment horizons, disciplined execution often produces stronger risk-adjusted returns. Now, from a valuation standpoint, investors may debate whether JKHY deserves a premium multiple compared to slower growth businesses. But high-quality recurring revenue companies often command stronger valuations because investors value predictability, customer retention, and financial resilience. And honestly, predictability has become increasingly valuable in uncertain markets. When economic conditions become volatile, investors naturally gravitate toward businesses they can understand and trust. Jack Henry fits that category surprisingly well. Now, if you look across all three companies discussed in this video, there is actually a very important common theme connecting them. None of these businesses rely on hype, none of them depend on speculative promises, and none of them require perfect economic conditions to survive. Instead, all three companies generate value through durability, recurring demand, trusted relationships, and consistent execution. Church & Dwight benefits from household consumer loyalty, McCormick benefits from deeply embedded food and flavor demand, and Jack Henry benefits from mission-critical financial infrastructure dependence. Different industries, different business models, but the same core investing principle. Own businesses, people continue relying on regardless of market cycles. Because long-term investing success is often less about predicting the next exciting trend and more about identifying durable companies capable of compounding steadily over many years. And personally, I think that lesson becomes even more important in today's environment where so many investors constantly chase short-term excitement instead of focusing on business quality. Now, I want to ask you a question. Out of these three businesses, which company do you believe has the strongest long-term competitive advantage and the best chance to continue compounding shareholder value over the next decade? Is it the consumer stability of Church & Dwight, the global brand power of McCormick, or the mission-critical banking infrastructure of Jack Henry? Let me know your thoughts in the comments below because I would genuinely love to hear your perspective. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.